Today, we're diving deep into the case for physical silver. We're going to look at its long history as money, its absolutely critical role in modern industry, and the core argument that it's not just a metal, but a form of financial insurance for some pretty uncertain times.
But first, let's just start with a really fundamental question. We see the numbers in our bank accounts, we have cash in our wallets, and we just kind of assume it's all stable. But according to our sources, the history of money is just littered with failures. So is the ground beneath our financial feet really as solid as we all think it is?
To put a real number on that question, check this out. 85%. That's how much purchasing power the US dollar has lost since it was officially disconnected from gold back in 1971. That's not some abstract theory. That's a real-world, tangible erosion of your wealth over the last 50-plus years.
And that loss of purchasing power isn't just a story about past inflation. The sources we're digging into today point to a much deeper, more structural problem with how government finance works right now, what they call a truly unsustainable path.
Okay, take a look at these numbers from the Congressional Budget Office. The trajectory is just staggering. Federal debt is on track to jump from about 101% of GDP to 120% in just a decade. But here's the kicker. Look at the net interest payments. That's the cost just to service the debt we already have. It's projected to more than double, from almost $1 trillion a year to over $2 trillion.
And this, right here, is what our source calls the interest burden spiral. By 2036, more than a quarter, a full 26% of all federal tax money is projected to just go to paying interest. It's this dangerous feedback loop. You need more borrowing to pay the interest, which makes the debt bigger, which then makes the future interest payments even bigger. And according to the source, the easiest political escape hatch from a trap like that is often diluting the currency, which brings us right back to that loss of purchasing power.
So how in the world did we get here? Well, this system of unbacked paper currency is actually a super recent experiment in the grand scheme of things. For literally thousands of years, money was something completely different.
This timeline gives us the quick and dirty history. Before World War I, money was backed by actual physical gold. Then, after World War II, we had the Bretton Woods system, where the US dollar was backed by gold and every other currency was pegged to the dollar. But then, the big one. 1971, the Nixon shock. The US temporarily slammed the gold window shut. And that temporary measure? Well, it's been over 50 years, and we've been in this global fiat era ever since.
And that brings us to a really important distinction our source makes. We use the words money and currency like they're the same thing, but they're not. Currency, like that dollar bill, is just a medium of exchange. It's a promise from a government. But money, in the historical sense, is an asset that stores value all by itself. For millennia, that job belonged to gold and silver.
Okay, so we know both gold and silver have been money for, well, forever. But the source makes a really specific case for silver, arguing it has some key advantages over gold, especially for the average person, not a central bank, but for you and me. The first advantage is just pure practicality. Let's imagine a crisis scenario where you might actually need to use this stuff. A single 1-ounce gold coin is worth thousands of dollars. So how are you going to buy a loaf of bread with that, or a tank of gas? You'd have to find and trust somebody to make change. Silver, on the other hand, while it's much lower value per ounce, is way more divisible and actually useful for small, everyday transactions.
Now, this is a big one. There's a fascinating historical precedent to think about. Back in the 1930s, the US government actually confiscated privately held gold and then went after both bullion and coins. A year later, a similar order came out for silver, but, and this is the crucial part, all silver coins were specifically exempt. For anyone worried that history might repeat itself, that's a pretty significant detail.
Think about it this way. Gold mostly just sits there, in jewelry boxes or deep in a vault. But silver gets used. About half of all silver demand comes from industry. We're talking solar panels, electric vehicles, all kinds of electronics. This means silver has a strong demand floor that's based on it being consumed in the real world. It actually gets used up, and that provides a structural support for its value that has nothing to do with its role as money.
And finally, let's talk valuation, specifically the gold-to-silver ratio. All that means is how many ounces of silver does it take to buy 1 ounce of gold? For huge stretches of history, that ratio was around 15-to-1. Today, it's way up around 65-to-1. The argument our source makes is that if this ratio ever starts heading back toward its historical average, then silver has a whole lot of room to run relative to gold.
Okay, but let's be real. It's not all sunshine and roses. Holding physical metal comes with its own set of very real risks and some powerful counterarguments which the source material is very clear about.
And you can't talk about the downsides without bringing up the most famous critique of all, from the man himself, Warren Buffett. His point, in a nutshell, is that gold, and by extension silver, is a non-productive asset. It doesn't generate income, it doesn't pay dividends, it doesn't build anything, it just sits there. Its value depends entirely on someone else paying more for it down the road. It's a really powerful argument from one of the greatest investors ever.
And beyond that, there are some very practical trade-offs. For one, silver is famously volatile. I mean, the price can get cut in half or even more. It also pays no yield, so there's an opportunity cost. The money you put in silver isn't earning interest or dividends somewhere else. Plus, you've got to think about storing it safely and securely, and you're always going to pay premiums when you buy and face dealer spreads when you sell, which chips away at your returns.
So with all that volatility and all those risks, how do people who believe in this actually do it? How do they accumulate it without trying to perfectly time the market?
The strategy they use is called dollar-cost averaging. And honestly, the idea is super simple. You just invest a fixed amount of money on a regular schedule, say every week or every month. You just buy automatically, whether the price is high or low. The whole point is to average out your purchase cost over time, which smooths out those wild price swings and, most importantly, takes emotion completely out of the equation.
All right, so we've looked at the history, the pros, the cons. Where does that leave us? What's the big idea here?
And this really is the core thesis. The sources we're looking at don't pitch physical silver as some get-rich-quick scheme. Not at all. They frame it as a form of long-term financial insurance. It's a defensive asset you hold to protect your wealth against things like currency debasement and systemic risk. You don't buy fire insurance hoping your house burns down, and advocates would say you hold silver for the exact same reason.
Which leaves us with the big question to chew on. Is physical silver just some barbarous relic, as its critics call it, totally out of place in a modern portfolio? Or, as our source material argues, is it a timeless and essential form of financial insurance that might be more relevant now than ever? That's the debate, and it's definitely one worth thinking about.